Good afternoon or good morning, everybody, and welcome to the webinar. So I'll start with a summary. Banks are pretty well placed to generate revenue growth from commercial payments, but that growth is only going to be unlocked through innovation. And at Ixaris, we believe taking virtualization further is going to be key to making this happen. Okay. To start with, I'd like to go through a quick SWOT on the commercial card business, starting with the main strength. The model is attractive for buyers, it provides credit, it provides rebates, and commercial interchange today in Europe is 6 times higher than commercial interchange than consumer interchange, and that makes it really attractive for card issuers to be doing more of the commercial cards business. But there are also weaknesses we all know about. Commercial cards have a relatively low share of commercial spend when compared to other methods like checks, wires, and we all know that the established tactic for competing is ever-increasing rebate, and that's a spiral of ever lower profitability. The main opportunity is that there's a lot of latent demand in the market. If you take the McKinsey quotes there, that on a relative basis, EMEA and APAC still account for 1/6 of use or revenues from commercial cards than does the US. So there's plenty to go after in these regions. There's plenty to go after for the US too, in fact, as we shall see. Now, one thing that's making things worse is this threat on high commercial interchange. And regulators seem to be fighting each other to see which one of them would lower interchange the most. The recent reprieve, which we are all sort of relieved by in Europe, is going to be reviewed within 3 years. So interchange might yet fall after that review. Are commercial issuers making plans to survive in this post-interchange world? And there's another threat, which is the fact that tech-savvy, highly focused fintech companies have spotted the B2B payments opportunity, and they're starting to capture market share. If you take examples in the US, Global V Card and Boost, they are the tech-savvy, capable players that are eating market share in commercial card payments. But there's good news. Virtual cards offer a fantastic opportunity to increase the spend per customer, to unlock new sources of revenue, and importantly, to increase profitability. This quote by Ashish from Deutsche Bank highlights the opportunity for the US, and a similar opportunity exists in the rest of the world. In this webinar, we'll be taking a look at 4 responses commercial card issuers can take to drive advantage. The first being increasing the share of business spend, extending the use of cards by businesses beyond the traditional supplier payments and purchasing, specializing in solving problems within attractive verticals. And the fourth is to challenge and somehow improve for themselves the economics of card payments to extract more profit from a given volume of spend. So let's move to recap on the state of the commercial cards market today. Commercial cards offer a great option for relatively low value payments and ad hoc purchases. And they deliver cash flow and control benefits to both buyers and suppliers. However, the share of spend has remained stubbornly low, at least for the more traditional programs. And this is because the card's model doesn't quite fit the accounts payable process. Now, virtual cards have been instrumental in improving that fit, and they are already driving the evolution of the use of cards for supplier payments and generally for accounts payable. So from the early days of P cards we have now moved to the widespread use of single-use accounts, and more recently we're starting to see straight-through processing where a bank-based payment is involved at the back end of it, and also buyer-initiated payments where the buyers are pushing the payment straight through rather than going through the traditional concept of a checkout or card acquiring transaction. So why is virtualization the answer? To do that, let's remind ourselves of the key features of virtual cards. So virtual account numbers, they're not just payment cards without the plastic. They're genuinely a better mousetrap for payments. Virtual cards can be issued, funded, and delivered in real time at almost zero cost. And there are virtual card types to cover a whole range of use cases. The single load, multi-spend, single load, single spend, a variety of use cases. They work on debit, prepaid, or even a credit basis. The fact that you can instantly update the values, cancel them instantly, restrict merchant category codes, put time validity windows, they provide a lot of capability for fine-grained control. And single-use virtual cards in particular, when they are linked to external data sources, such as order numbers, purchase order numbers, they can support precise and automated reconciliation for both buyers and suppliers. And this has been a traditional weakness of the commercial cards programs. Virtual cards can also be used as standalone accounts, as in the case of prepaid, for example. They can be associated with a credit or a debit account. And more recently, tokens, or rather token pans, that cards, but in fact are just references, are proxies to actual account cards or account numbers. These can bring greater security for a whole range of uses, the most obvious one being card on file. So to recap, so far we've looked at the state of the commercial cards payments or the evolution of it, and had a look about why virtual cards offer such promise as key enablers of innovation. The next part of the webinar will look to taking virtualization further, and we'll explore 4 areas where issuers can drive advantage. The first is increasing the share of spend, extending the use of cards for activities, payment activities beyond purchasing or supplier payments, specializing in solving problems within lucrative verticals, and then somehow challenging the economics of card payments to derive more profitability. So let's take each of these in turn. Okay, so the first one is around increasing the share of spend, and we're doing this through supplier enablement, better data, better plumbing, and also giving financial benefits to the parties. A recent development has been the shift towards buyer-initiated or push payments, and these deposit the funds to the supplier without the supplier needing to acquire the virtual card that is used for the payment. Now, virtual cards are very adept at this, and a number of straight-through processing solutions are now in the market. These turn a settlement on a virtual card into funds that are pushed directly to the supplier's bank account. And the card schemes are doing this. So MasterCard Payment Gateway and Visa straight-through processing, both really started in the US, already doing this. And there are also some commercial products. Boost Intercept is probably the most, the most obvious one. Data. There are now better facilities for the buyer to link order information with the payment transactions. But for suppliers, the purchase information is still very limited, and this is a source of source of control weakness for the suppliers. Card scheme level 3 data is useful, but it's not that widespread. Beyond the US, the UK, perhaps the Netherlands, there's an absence of rich transaction data. Now, single-use virtual cards can be linked to both the buyer and the supplier data, and linked to invoice number, order number, purchase order number, and this helps both parties. So data and payments come together in virtual cards. And the flexibility of virtual cards powers the trend for tighter integration between payments and the business networks that give rise to the supplier-buyer activity in the first place. Networks like Ariba, teamed up with Discover to provide this, and then more recently Mastercard and Badsware are looking to do something similar. More cost effective. Suppliers have been very sensitive to the cost of accepting cards. Commercial interchange is high, that's what feeds the rebate, and that is of course a cost that suppliers have to bear. Now that meant that these cards were not appropriate for high value payments. And the schemes have responded to this. They have reduced the interchange or have special proprietary rates for certain types of merchant IDs, that's by special arrangement, or for large amounts. The Visa Large Purchase Advantage, for example, is a good example of that. The Mastercard straight-through processing or payment gateway program, again, similarly has priced so that more of the buyer activity can actually go through the straight-through processing solution, and a generally large ticket interchange rate, which is very different from the typical ranges of average transaction values that card transactions are designed for. Later, we'll look at an even more aggressive measures to reduce costs for buyers and suppliers. There are also big cash flow benefits. The suppliers have always liked the T+1 settlement from card transactions, and buyers, of course, they have liked the credit. They have certainly liked the rebates that comes with commercial cards. But there's more scope for cash flow benefit, and that comes from supply chain finance, especially reverse factoring, where the supplier can get paid early based on the buyer's support and the credit rating, and sometimes buyers can turn that into a discount ultimately for themselves. Again, the virtual card can act as a vector for payment enabling the buyer, supplier, and financier interaction in providing this kind of supply chain finance, because it gives visibility, it gives control, and also the ability to deliver payments efficiently. Okay, so now let's move beyond purchasing or beyond supplier payments. In addition to paying suppliers, businesses make all sorts of payments. The obvious example is payroll, but there are also other forms of payments: incentive payments, rewards, dividends, refunds, and in specific verticals, there are sometimes very specialized forms of payment. Think of insurance payouts, for instance, very specific to the insurance industry. So take incentives. So SPIFs, as I believe are called in the US, allow businesses to directly incentivize salespeople at their distributors. And the recent survey shows that employees overwhelmingly prefer payments over gifts or even gift cards. The volumes for incentive payments, when you aggregate them, they're quite large. It's about $85 billion in North America and Europe by one count. But individual payments are quite small and sporadic. So this makes the sector suitable for virtual prepaid cards that can be created and delivered at very low costs. It also provides the corporate using them with an opportunity to add branding, to add messaging with the payment through the user interface that's used to access the virtual card. And that certainly beats the check in terms of user experience. To illustrate a disbursement use case, I've taken this example from IMS. So IMS collects medical market data from over 100,000 doctors worldwide. And they wanted to replace shopping vouchers as an incentive for doctors to fill in the questionnaires and take part in this market data collection activity. But the solution needed to compete with these shopping vouchers, which typically cost less than their face value. And also the whole experience for the doctors needed to be compelling, so that the medics will be active takers or participants in the market data activities. The solution they've used is to use a virtual prepaid card to pay the doctors upon the submitting a questionnaire or taking part in an interview. And they've used a virtual first approach. In fact, IMS offered a free upgrade to a physical card, to a plastic card, for any doctor that wants it. And in practice, less than a third of the doctors chose the free upgrade to plastic. So it does deliver on the low-cost, instant, method of payment that engages the doctor and brings the doctor to the appropriate website that that IMS wanted them to visit. Also, the centralized payment operations, sourcing shopping vouchers in many markets around the world is quite hard work. And the centralized payment operations significantly reduce the operational cost. It's also reduced the internal fraud risks for IMS. Now, for the payment provider, for the issuer of these virtual cards, there were benefits too. The charging model was value-based and fixed fee per card. And in fact, interchange was only a very minor contributor to the revenues of this program. So there's an example of a fee-generating business model on commercial cards. I'm going to move on to an area which is increasingly becoming important to commercial card issuers, focusing on specific verticals. Traditional commercial cards and even standard virtual card solutions, they're often not fit for purpose. To really deliver the solutions, the maximum benefits in some of the more lucrative but also potentially challenging verticals. There is an opportunity to extract value by delivering these vertical specific solutions. Take the travel sector as an example. Beyond issuing virtual cards for purchasing and using virtual cards, online travel agents, they require support for very specific requirements. First, they need support for both credit and prepaid facilities. Most of the travel agents run out of credit, and therefore, to continue using virtual cards, they would need to rely on a debit or prepaid model. Many of them are too small to qualify for any substantial forms of credit. Travel agents, especially online travel agents, operate at very tiny margins, so the cost of payments can be crippling. Cost of surcharge, cost of the cost of foreign exchange, they're quite a substantial, they eat substantially into their margin. And by using the right type of cards, they can maximize on avoidance of surcharge, they can maximize on the collection of rebates to make up for those payment costs. And it makes a real big difference to their bottom line. Again, in travel, a substantial portion of travel spend is on hotels. Now, when using single-use virtual cards in a hotel, the card mustn't be destroyed upon the hotel attempting a small value transaction to check that the card is live. Because if that happens, then the card will no longer be usable for the actual payment of the hotel stay. So that's a tweak that has to be specific for travel. And again, to optimize working capital, travel agents can take the opportunity to load funds on a card just in time before the hotel stay is due to begin. So again, the model is not a standard virtual card model, but is very specific to the way hotel payments work. And finally, because of the volume of cards being processed and the volume of purchasing activity, API delivery is an absolute must in this industry. And this is a sector that has seen considerable growth. Banks have lost ground against agile and specialized setups. One provider in 2014, for which data is available, experienced a 50% revenue growth in the order of 67 million just from the sector alone. And that provider is not a bank. Now, similarly, specialized requirements are evident in other verticals: online media, insurance, real estate management, construction. And the specialist providers are emerging. Blue Tarp in construction, for instance, Anchor Ops in media. It's worth calling out insurance as a really high potential market. Possibly not as attractive, but certainly comparable to travel. For instance, European healthcare insurance alone has payouts of around £94 billion. That's $136 billion annually, and mostly being paid through check and bank wires today. Virtual card payments could bring huge benefits in this sector through greater visibility, better control, access to rebates to manage costs, and also the reconciliation benefits. For commercial card issuers, this is a very relatively untapped opportunity to address both the B2B and B2C payment flows in insurance. To illustrate this, I have another case study that talks about the B2B element of travel assistance. So AXA Assistance manages 8.5 million case files annually around the world. It has struggled with the complexity of making emergency payments around the world, often to remote suppliers that need payment quickly when AXA customers were injured or in need of urgent attention. And the cash disbursement costs were high, reconciliation a huge headache, very poor controls, and after-event charges, sometimes months later, became a real cause for concern for them. The virtual card solutions delivered significant cost savings, improved the reconciliation and the control, and the delivery of payments in real time was a big game changer for AXA. And the issuer is benefiting from charging a fee per virtual card created, in addition to the interchange and forex benefits. So finally, looking at our fourth response to drive greater profitability from commercial card activities for issuers. This is probably the more future gazing of the four we've looked at, but it's very relevant, especially today with the threat of the fall in interchange. And it's, in my view, critical for card issuers to take a look at the post-high interchange scenario. Okay, we already saw straight-to-processing earlier, as introduced by Visa and MasterCard in the US, and that already promises better economics and also payment status visibility for buyers and suppliers. But in fact, that's only a starting point. STP can be made much more cost-effective and also extended internationally. And the way to do it is to assign a hidden virtual account for each supplier. This will act as a merchant account. And then funds received on that merchant account can be pushed to the bank account of the supplier. Now, neither acquirers nor card schemes are actually needed to achieve this. With the right technology, the issuer, who really has the relationship with the buyer to start with, can do it on their own. And push settlement of aggregated funds can be done via the local bank networks. They can be done via overlay services such as InPay, and eventually through emerging technologies like Ripple or even blockchain-based value transfers. So to go further, integrating virtual card capability with e-procurement technologies, e-marketplaces, e-invoicing, and so on. These are technologies out there, especially targeting certain verticals like Amadeus, Basware, Tradeshift, and Ariba. It can bring significant benefits to the issuer. Why? Because it results in a lower cost for onboarding buyers and suppliers, as they're already integrated in the system. It also means that the issuer is able to serve smaller buyers very cost effectively, and therefore scaling up the potential size of the card program. More importantly, these are data-rich environments, and the sum of rich data and payments is greater than the parts. Both buyers and suppliers derive great value from the combination of the two. And finally, as clearing and settlement, even through virtual cards, become a commodity, especially if interchange drops. And if interchange does drop, this will push down pricing across the whole value chain. The money will need to be made from value-added services. Virtual cards are a highly flexible delivery mechanism for third parties to inject value into the supply chain because of their real-time nature, because of the data richness and the fine-grained control they provide. So examples are, if you can't make money from credit interchange, you can start to price for credit separately through credit lines. You can start to offer foreign exchange as a separate service beyond what's done through the card schemes. And again, we talked about some supply chain finance options that are already starting to be made available. And more exotic services such as escrow and insurance services can be added on through the delivery mechanism of a virtual card-based solution. Okay. Before I summarize and go on to questions, let me give you some context on what you heard today by introducing Ixaris. Well, Ixaris is a technology platform for payments innovation. We pioneered the single-use and reloadable virtual prepaid cards in 2003. And since then, we've evolved. Our open payments platform is now card agnostic and bridges diverse payment rails. And this allows us to optimize, optimize the flow of payments to the benefit of buyers, sellers, and of course, the financial institutions themselves. Okay, so to summarize, banks have a great opportunity to deliver growth from commercial payments, but they can't stand still. They need to innovate. And virtual cards and increased virtualization gives them a way to do this. There's only one way interchange is going to go, and that's down. And so it's important for commercial card issuers to start exploring business models to lead to a response for an ultimately low interchange world. And we've looked at 4 approaches. One is about increasing the amount of payments that businesses do that will go through commercial cards or commercial virtual cards, as we've described them. Extending the use of cards beyond the purchasing activity of businesses means we get a bigger addressable market. Specializing in vertical solutions gives us greater value capture, greater stickiness, greater competitive advantage. And then by disrupting or challenging the economics, it is possible to derive more revenue and more profitability from a given share of spend. What do you guys think?
Well, thank you very much, Alex. Thank you very much indeed. We're now going to move on to the Q&A section of the presentation. So the questions, and by the way, if we don't get to answer them all, Alex is very happy to answer them later via email and things like that. So the questions we have at the moment, the answer is always saying yes, everyone in this presentation will receive a copy of the slide deck. That's absolutely no problem at all. Alex will be speaking at the forthcoming European Commercial Card and Payment Summit, the CPI one, which I'll give you details before we move on. And we do have an opportunity to ask questions if anyone would like one now. So please just type your question into the question box, and we'd be very happy to answer it. Although I have to say it was an incredibly thorough presentation, so it might, people probably need to digest a little bit about what you said. So here's a question: how does mobile fit in?
Yeah, no, very, very topical question. Well, mobile is one of those sort of last mile technologies to increase adoption. Again, we talked about increasing the share of spend, and one way to increase the share of spend is to give the power of employee purchasing. Typical travel and expenses type programs already address this with with physical cards. Mobile gives the ability for a business to make this purchasing capability available to all the employees and have central control to be, in real time, deliver cards to mobiles for use for a specific trip, approve value purchases, purchases of certain value that would typically require approval, and do it in real time. So mobile is a great delivery channel, and it means extending the reach of commercial cards and virtual cards in particular from the center of the purchasing function or the finance team out into the employee activity across the whole organization.
Okay, well, the questions are coming in now. Are there any US issuers using virtual commercial cards today that you're aware
of? Yes, there are. Virtual cards in the US are quite established. They're, I think the one probably most well known is WEX, that issues virtual cards. But most of the banks with commercial card operations have some virtual card program running. The question is, to what extent are they exploiting that virtualization? And I think that's a real mixed bag.
Probably difficult to answer the next one. Market penetration of virtual cards in the US and UK, would you say very low at the moment, or?
Well, It's as we saw from the quote by actually from Deutsche Bank. There's brisk growth rate of virtual cards in the US to reach 160 billion this year. When you compare that to the spend, the commercial spend, which is in the order of trillions of dollars, then it's still a relatively low penetration. Therefore, that's why there is such a scale of opportunity. Having a better mousetrap means you can capture more and more of that business spend, which is very significantly greater than what is going to commercial cards at the moment.
What about the role of acquiring? Someone says, shouldn't acquiring play a greater role in helping businesses realize the benefits of V-card acceptance?
Well, acquirers already do this, right? So acquirers are what help the suppliers in a traditional program collect their money. They're taking the payment card and then depositing the funds with the supplier. I think the problem, especially in a low interchange world, is that there are many mouths to feed, and therefore there's a challenge about all the costs that stack up in the delivery of a payment. I think there's a very great role for acquirers to play, simply because they have relationships with merchants. Many of which will end up being suppliers, but somehow we need to find a way of getting cost out of the system for this whole thing to be viable as interchange gets lower around the world.
So does the transaction always involve card payments, or are you able to deliver payments via bank networks such as ACH?
Oh, that's the key to better economics, and this mixed mode between the fine-grained control and visibility of virtual cards, but also the delivery of money through appropriate bank networks for really just for making sure the economics work. That's where the trick lies. And the way they are mixed depends on who you are, right? If you're a card scheme, obviously you will mix them in a certain way. If you are a financial institution, you would probably opt for a different mix to make the economics work in your favor. That is absolutely the trick, to exploit the best of both.
So, with electronic payment systems, wires and ACH, across the world starting to get enhanced, they're becoming increasingly real-time and carrying a lot more data. Do you still see the value in straight-through processing application of virtual card capabilities? Aren't they a lot more expensive than ACH?
Well, I think there is a real convergence, right? So in Europe with the PSD2, which is a piece of legislation forcing banks to provide access to bank account information through APIs, it means that it's possible to create an overlay on top of the existing bank account infrastructure and create payment card-like services. So in practice, what seems to be happening is from the cards world, there's a push towards increasing the involvement of bank transfer to improve the economics. From the world of bank transfer, there is an enhancement to give more sort of API-driven and data-rich environments to create payments. So there's a convergence between those two worlds, and and eventually there will be best practice around which bits to do on a token basis. We won't even talk about virtual cards eventually. We'll simply be working with tokens, and which aspects of the payment will happen through good old bank transfer, possibly in the last mile in the local environment.
So how can virtual cards be used as a gift card?
Well, actually, virtual cards have huge potential as gift cards. At the moment we think of gift cards as being something which at best have nice packaging in the front, and going beyond the sort of transfer of value from the person giving the gift and the person receiving it. Virtual cards allows you to create a rich experience. You can deliver a virtual card while recording a video singing happy birthday, or passing a specific message, or passing in promotional messages from a corporation that really wants to hammer its message home as it's delivering an incentive payment. It's a much more rich environment around which to create user experiences.
And can the recipient only use it online, a virtual card?
Generally, they would use it online. However, there are ways to be able to allow the money to be sucked out into a personal bank account. There's also, although the penetration is still very low, cardless ATMs where, by having a virtual card, you can go type in a PIN and your virtual card number and actually get the cash out of a cardless ATM. But that penetration is still very low of those ATMs.
What is the experience in splits between procurement volume and travel volume on vCard? Is the real volume opportunity in procurement or prepaid?
So, sorry, the split being between
what
prepaid?
Is the experience in split between procurement volume and travel volume on vCard? Is the real volume opportunity in procurement?
Yes. So the use in when I interpret travel to mean travel and expenses and context. Virtual cards are not used hugely in travel and expenses environments simply because there's an education both for the employee to use them as well as for the as the merchants. Now, interestingly, hotels are becoming more adept, and if you look at systems like AirPlus AIDA, for example, which has a mobile element, this is starting to be more and more adopted. But relatively, it's a very tiny portion of use of virtual cards compared to the use in procurement. Now, there was another element on prepaid in that question, which
It just says prepaid question mark. Perhaps the question that could give us a little bit more detail on that. And while Alex is having a bit of a breather, let me answer the questions that I'm qualified to answer, which is, yes, we're happy to provide Alex's email. I assume he doesn't mind on that one.
Sure.
And yes, the recording of this webinar will be made available to everybody very, very shortly. So we have a great question here which comes up at every CPI summit, and it begins with the word, is plastic doomed? If so, how much longer will it live on in a commercial card/B2B payments context? I think everyone has an opinion on that. What's yours, Alex?
Sure. Well, I think ultimately plastic is doomed, just like the sort of card base on which cards were originally printed is doomed, and like the sort of swipe machines are doomed. These technologies, though, they last a long time, right? There's a sort of decay rate that goes on for many, many years, and I expect plastic will follow a similar trajectory.
Okay. Thank you for that one. I think you covered some of these that people don't. Do you think industries that use a lot of SME suppliers, such as the construction industry, would benefit from V cards?
I think they would, and they would because they would, especially if on top of virtual cards, the value-added services can be built. So I mentioned the blue type as an example, and the idea to be able to give SMEs some form of credit or supply chain finance makes a real big difference to small businesses. And to the extent that virtual cards enable these value-added services, I think it's a real big plus and a real opportunity. The same thing is happening with say anchor ops in the world of media, right? Behalf with again SMEs.
Okay, but there are one or two. We're now getting to the end of the 40 minutes allowed for this, and we like to keep them on time. So any other questions that haven't been answered, we can get back to you on. There's questions about the euro interchange review. There is a very big session on European regulation coming up at the European Summit. I don't think a date's been set yet. So I'd like to thank you all very much for your questions. If it hasn't been answered, we can get onto it in the response pack that's going to go to everybody. But most of all, I'd like to thank you, Alex, for a very, very interesting and in-depth presentation. Thank you very much indeed. And we look forward to seeing you at the European Commercial Card and Payment Summit, which is coming up next month in London. So we look forward to meeting you all there. Alex will be speaking. Thank you and goodbye.